Welcome to our podcast. This is Friends on Fire.
I'm Mike. I'm a lifelong devotee of financial independence. I even wrote a book about it.
And I'm Maggie, a newer convert, but just as passionate, especially on the intersection of minimalism and financial independence.
We're one and the same.
We are two like-minded friends who believe that talking about money with your friends and family opens the door to financial well-being.
The Friends on Fire podcast is about dispelling myths, building financial acumen, and sharing your financial independence journey with the people you care about.
This is Friends on Fire.
Hey, Mike.
Hey, Maggie.
How's it going?
It's going great. We are in the midst of your retirement announcement, and
yeah,
I can only imagine what it is like for you right now, because the amount of people talking to me about it is pretty overwhelming.
It has been an emotional week, like in a good way. It's also just been a particularly busy week in a number of aspects. And so it's been a crazy week. And from that end of like the news coming out and just, I've been hearing from a lot of people, like, it's great. It's very reaffirming, honestly, in many ways. And it's been great to hear from so many people and such, kind of kind words and sentiments from everyone in, more the professional community and colleagues, current colleagues and past colleagues, but also just more personally, like socially and, people in the fire space on social media, et cetera. And just to get, the support and encouragement. Some of my favorite comments are from people who are like, lots of people talk about early retirement, but you're the first person I've known who's actually, and lots of people have actually done this, to be clear. It's just interesting in smaller circles of people saying, and just that it's cool to actually see someone doing it. And so, it's been, we sometimes record episodes, a couple weeks in advance, sometimes a week in advance. This one we're recording, it's Saturday morning, and we're recording it at the end of the week that we announced this. And so it's very fresh. And I'll tell you, the number one question I get after a congratulations and a, some sort of nice note is,
what the hell's wrong with you?
No, not
sorry.
that.
Continue.
I sometimes ask myself that. No, it is, what are you doing for medical benefits? It is the number one question I get from people who know me well and who don't know me well.
Yeah. And I think the short answer is your medical benefits go away and you need to figure out how you're going to insure yourself.
You're right. Yeah. I keep saying benefits and Mike says, you don't get benefits anymore. You now buy insurance. And I'm like, you're right. You're right. I got to get the word benefit out of my head. Yes. So the number one question I get is medical insurance. And I literally have gotten this question 100 times we've gotten it just in general before I even announced that I am retiring. I'm not going to read all the listener questions, but I will read one person's question. This one actually came to us from a listener named Avi before I even announced my retirement, and said, great show as usual. $1 million question. Hopefully not literally. How are you each planning to pay for health insurance? Which again is just, that's the nature of the questions we get on this topic. And we're finally going to address it.
It's a little sad and says something to the state of our country that this is like the biggest question that we get. How are you going to make sure that you don't die from a medical emergency?
Yeah. And not even like, how are you going to pay for this? Which we just did an episode on that, last week, but more, how are you going to pay for insurance? It's just funny that is the question, because insurance is a cost and it's going to be a big cost for us, but it's not the biggest cost. The biggest cost is just living, right? Eating, right. Being able to still being able to, continue to
buying exercise equipment,
be a human in this consumeristic society where I do need a new treadmill every now and then. Exactly. Yes. So yeah. And I should say, before we jump into that, we talked about this a second ago, Mike, but I really do want to just say a huge thank you to everyone, because I really appreciate all the notes that I've been getting from people. And Mike, as you were joking, but being totally serious, you've been getting just as many notes from people and people reaching out to you. And I just appreciate it. So thank you for all of the amazing energy that all of you have sent my way, my husband's way, and Mike's way, who is the third wheel in this journey, on this journey with us. We really appreciate just all of the very nice notes and sentiments and just encouragement, honestly, because it means a lot.
All right, Maggie, let's jump into medical insurance.
Let's dig in. So first off, we should make a caveat on this topic in particular. This is 100% US relevant and focused. If you live in another country, there's often way better setups for insurance in the first place.
Often? I think you mean always.
Pretty much any other country.
We have some listeners in Europe that I know personally, and I'm sure they're listening to this and be like, what the hell are you guys talking about?
Yeah, what's the big deal? Why is
Don't
everybody
you just
care?
get it?
Yes. So yeah, this is a relevant episode if you're in the United States. There's perhaps a few learnings in here for people elsewhere, but yeah, this is gonna matter mostly and be relevant and accurate to. And look, I'm not even gonna promise any of this is accurate, but if it was accurate, it'd be accurate in the United States. And I'm gonna get into at the end of this episode, I'm gonna get into exact numbers of what it's going to cost us and what we're going to do for insurance. But I think it's important to just start with a few thoughts on the concept of early retirement, the concept of medical insurance, and frame up this discussion because everyone's unique situation and details are going to be different. And again, I'm going to get into mine specifically, but just some high level things that I think are important for folks to understand. Let's run through those, Mike.
The first one is that insurance is a product that you buy from another company. It's not like a special club for people who work in established businesses. You put in more money than you get out on average. That's how insurance companies make money. And so, I'm constantly surprised by how many people ask about this, because think of it this way. Like, let's say you get a company car and you're very lucky. It's not like people are saying like, oh my God, how are you going to find a car after you leave your job? Like, well, you just buy it. The company stops giving you money for it, but there are cars out there and you can drive them. And insurance is no different. The system is set up to be super complicated and make you feel like the only option is to get it through work, but it's not the case.
But to that point, it is going to be more expensive, most likely, almost always, than what you currently are paying as part of a W-2 job, right? So I will say I now appreciate how much. I always knew my employer was paying a portion of my insurance and that I was paying a portion. I'll tell you, I never quite appreciated how much they were paying. I now know because of COBRA rates, which we'll talk about at the end, the exact amounts. But your employer's paying a lot. So either your employer's paying it or you're paying it.
Yeah.
Right.
Well said.
And ultimately, think of this as the cost of freedom, right? So you can get frustrated. You can get in a mindset where you're frustrated and you feel trapped because of it. And you're like, I can't leave my job because I need insurance. And again, we could apply this to all forms of work, not just insurance. Just the mindset of feeling trapped and not like you're going to have to do some job forever. Not true. You could plan and be disciplined and find a way to live below your means and make some trade-offs in your life. And insurance is the same way, right? So you can research, plan, budget for it, choose the best option, and just move on with everything else you want to do in your life and pursue your dreams and just accept that a higher cost of insurance is going to be the cost of your freedom, right? Whether you want to retire early or be an entrepreneur or whatever you want to do that's not tied to, working for a more established company that will subsidize the cost of your medical insurance.
And then the next point is that it may seem obvious, but you should budget for this cost and include it in your estimates for what you're going to need in the future. This could be $10,000 or $20,000 or $30,000 a year. It's expensive. And so if you're expecting to spend $50,000 a year in retirement, it's really going to be $60,000, $70,000, $80,000 a year because you need to factor this in.
And you also need to budget in the actual medical costs in addition to the cost of insurance.
Yeah.
So for example, we're going to do a high deductible plan, which we'll talk more about. So we also need to budget in out-of-pocket expenses that we will end up incurring, which are up until our deductible, obviously. And so you got to budget in both elements of that, which is important.
And the next point, and this is something that Maggie, you have done, and the result of this is this episode, is that do a lot of research and ask a lot of questions. There are people who are familiar with this, who work in this space. There are resources online. There are people who have gone through this before and can share their knowledge. And so make sure that you are doing research well in advance of making a life decision so that you don't quit your job and then find out you miscalculated.
Yeah. We'll talk more about this a little bit later, but when Mike says, I mean, there are people that will help you and walk you through this process. With the healthcare.gov and the ACA marketplace, there are actual roles called navigators, certified application counselors, agents and brokers that can help walk you through this. And they don't cost you anything, especially just in the research phase, right? They don't cost you anything. They're there to support you. I've talked to some of them. They're incredibly helpful. And they can give you a lot of information, even if you're planning on doing this 3 years from now, right? I talked to somebody months ago and I might say months ago, even longer ago, and was just having an exploratory discussion. I was like, hey, this is something that's going to happen out in the future. And they were incredibly nice and walked me through the whole process and answered my, bazillion questions on it. I think the last point here is, kind of tied to our point of that you need to budget for medical costs also. Remember that in addition to whatever you're going to end up paying to get insurance, there's also a lot of creative ways to save on medical expenses. And we did a whole episode on this recently on episode number 128, which was called Creative Ways to Save on Medical Expenses. So you can layer stuff like that on top of a plan that you end up buying through the marketplace or something like that. And it's just, I think an important thing to remember is even once you pick a plan, there's still ways to be frugal and kind of prudent in your medical expenses.
So Maggie, let's go through the different options that people have for getting insurance after they stop working.
Sure. And when I was making this list, Mike, I was even surprised at how many, right? There's a lot of different paths you could take. Mm-hmm. I mean, there's one particular path I'm going to take, but there are a lot of different paths you can take. Okay. First one is COBRA.
What does COBRA stand for?
Oh, geez.
You read it on a previous episode.
I did. And I Googled it real fast. Hold on. COBRA, Consolidated Omnibus Budget Reconciliation Act of 1985.
Yeah.
How could I not remember that?
I don't know. I thought it was going to be on the tip of your tongue.
Disappointed in myself. So COBRA is available right now. The policy can kind of change from time to time. But at this point in the world, whether you lose your job or resign yourself or quit, it's available for up to 18 months. And heads up, it's pretty expensive, right? So you can go and ask your company HR person today to share the COBRA rates with you for your company. It literally is the cost of what they're paying plus your premium, right? It's not some other like marked up rate or anything. I think there's some my husband's plan like noted an administration fee, but it was like really small, like low percentages. And so you can get a copy of that. But today, again, with insurance, you're paying your portion of the premium, your company's paying theirs. COBRA is basically those two things added together. And again, that's what reminded me just how much expensive insurance is anyways, which I kind of always knew. I just didn't really appreciate even how much my company was subsidizing it for me.
And to clarify one point about COBRA, the purpose of COBRA is to make sure that you have insurance available to you outside of the workplace after you leave. Now, the benefit, you had referred to this episode as the medical benefits. Yeah. The benefit of this goes away. You're no longer getting a subsidy, but you would get to keep your plan. You would keep your doctors. It is meant to bridge the gap between employment, and the current law states that you get to keep this for 1.5 years, which is great.
Yeah. And to your point, it's a bridge. So if you want to use it in early retirement, it's only going to last you 18 months and you're going to have to figure out, but it might give you some time to kind of, figure out what you want to do. For me, I mean, not to, steal the future thunder, I'm not going to use the bridge, but it is available. And I'll tell you why once we lay out the cost, you'll see why I don't want to use it.
The next one, which I think everybody's going to be familiar with at this point, is healthcare.gov, the Affordable Care Act, aka Obamacare. These plans have been available for a number of years now. And we will not go into too much detail because, spoiler alert, this is what you're doing. Sorry, did I just ruin it?
No, not at all. Because the fun part is I'm going to share the exact costs of everything.
Okay.
But the other thing I'd say when you were given all the AKAs, a lot of people call this the marketplace also, right? Like shopping in the marketplace, the ACA or the healthcare.gov marketplace. The next option is private health insurance. You can go direct to a Blue Cross Blue Shield as an example and buy health insurance. There's a couple of downsides of this. I'm not going to get into a lot of details on this. We'll put a link in the show notes to an article that actually compares private health insurance to the marketplace. A couple big downsides from my perspective is one, they don't allow you to qualify for the marketplace subsidies, which is probably to me the biggest thing. And I'll talk more about the value, literally like financial value of the subsidies and how great they can be. But also I've heard, this is not as official, but like I've heard there's some concern over like pre-existing conditions and other things that if something changes in the law, which like I know my husband was like, I don't think that's going to change. That would be a massive, like on all sides of political views, that would be a big change too. If they change something with the protection around pre-existing conditions. But you're just more protected, in my opinion, through the ACA plans from something like that ever changing.
The other thing to understand about when we say private health insurance is that you might have a Blue Cross plan at work, and that is simply your company buying a bunch of policies from Blue Cross.
Yeah, they've got a negotiated rate.
Yeah,
with
negotiated
them.
rate. There's going to be different terms, but you can go to your Blue Cross website and go like price out a plan. This is not like a secret program. You can go do this right now. You can read the fine print. You can see the premiums. You can see what's covered. I would encourage everybody, just out of curiosity, to go and look at this and see what they cost and see what they cover.
Yeah, I'll be honest. I didn't even price this out because of the lack of subsidies.
Mm-hmm.
But it's a good point. Maybe I'll go price it out later, just out of curiosity. So another type of plan, which I think maybe have talked about a little bit before on previous episodes, is what's called like healthcare sharing ministries. MediShare is a big, more popular one. I am not an expert on these in any way, and we're not going down this path because we don't even ideologically qualify. But some of the issues with these are that some don't cover pre-existing conditions, they don't cover mental health, some don't cover vaccinations. And ultimately, there's also a morality clause that can deny coverage for all sorts of things, from drinking to same-sex couples.
Also, technically, it's not insurance. So you use the term sharing. So people share
co-op.
the costs. And so this started with like religious groups. And basically, you send in your costs, and then the people who are contributing all of their premiums are essentially covering these costs for you, which is why they are under no legal obligation to cover certain things. And
there's no regulation. There's a lot of things that made me nervous about these.
Exactly.
I will put a link in the show notes to a really good YouTube video review that someone did on, I think on MediShare, or actually they just did it on healthcare ministries overall as a path.
Yeah. And then similar to the health sharing plans, there's companies like Sidecar Health, which Maggie, you and I had talked about and investigated with Greg a little bit. And it's not technically insurance, I don't think. It is just a reimbursement model for medical expenses.
Yeah, I mean, they market themselves as like a new more innovative approach to insurance. Yeah.
And the idea is that you still pay a premium. You still have to go see what's covered, but for every single thing that would happen to you, there's like a payout amount. And then it is up to you if like it pays out $1,000 for an ER visit. If your bill is $2,000, you're on the hook for the extra $1,000. If you only pay $800, you're still getting $1,000 back. And so it puts the responsibility on the owner of the policy to go find a good deal. But I think the thing that was a little bit of a turnoff for us on this one is that it's relatively new. It's not governed by a lot of the laws around insurance. And then the whole purpose of insurance for you and me, Maggie, is not to like save $5,000 on the year. It's to protect us if we need like $1 million brain surgery,
tumor. Yeah. Or a crazy ER visit.
Yeah. Or crazy ER. You break all the bones in your legs and you have to spend 6 months in the hospital or something. That's what we want to avoid. And so Sidecar Health is really convenient. It's cool. And I'm hoping that it expands and continues to perform well. But for what we need for our families, this was not like a viable option.
And specifically, the biggest issue is Sidecar Health has these maxes of what they will cover for each type of care, right? So if you get X type of literally it's listed by like X type of cancer or some sort of a, hospital, a broken leg, for example, or a hip replacement or whatever. And the max might be, $100,000 for a hip replacement. But if your hip replacement has some complications and you end up in the hospital for 2 weeks, that might not be covered because you've hit your max, right? And so it just, again, I think that piece was, I know, Greg's biggest issue with it. And then also, it's just not tried as true. It's not regulated. There's not enough history. And so to me, it's a bit of a gamble, and it kind of defeats the purpose of why I want insurance in many ways, which is for those crazy outlier scenarios.
Another option is that you could go enter into some other sort of work arrangement to get insurance paid for by a business, or subsidized by business, I should say. So think about working at Starbucks part-time, or any other business that offers part-time employees subsidized medical benefits. If you have a friend that owns a small business, try to figure out something with them. Companies will negotiate with insurance companies, as we mentioned. And so there are a bunch of different ways that you could go partner with a company in exchange for some of these benefits.
Yeah. And certainly if you're willing to work part-time, there's a ton of options. Starbucks being a great example, and many other businesses. Unfortunately, I'm properly retiring, so that's not going to work for us. Yeah. But it's a great path for people who are, leaving something and still, maybe perhaps need a little bit of extra income anyways. And then, the last option here, well, there's a couple more we'll get into, but is technically you can go without insurance. Now, let me be really clear. I am not recommending this, right? It is no longer a legal requirement in the US. It once was, and there was like a penalty if you didn't carry any insurance. That went away a few years ago. And again, wouldn't recommend it, but I'm just saying technically it's an option. What I think is if you're looking for like crazy options, like going without insurance, I will say I've seen a lot of people who kind of do some like version of geo arbitrage, where they essentially relocate to another country, are able to get resident status through a spouse or other ways that you can qualify over longer periods of time in other countries. And there's some other countries that have some pretty amazing medical care. So like I know a family I don't know them personally, but through social media that, moved to Portugal and are now qualified for medical benefits or insurance, whatever it's called, through Portugal. And it's a pretty great setup from what I understand.
There's a lot of interesting things that you can do when it comes to traveling overseas. There are travel insurance plans, which will, act as your primary insurance when you need to go to the emergency room or hospital or whatever overseas. And so if you want to be like a digital nomad, you can go get one of these plans. You don't need US health insurance if you're going to be international. Now, one caveat, if they fly you back to the United States for care and you don't have insurance, you are screwed. So it only works in that country. And then Maggie, as you mentioned, you can just go move to another country. Like this happens quite a bit. And this is like, Britta and I joke about this. This is our backup plan. It was like, if things just don't work in the US, we're going to move to Germany. College is going to be paid for. Medical care is going to be paid for. We will be fine. Well,
and you benefit from, I assume, dual citizenship, or at least through Britta somehow, because she's got dual citizenship. But the average person doesn't have that. So be careful. We're not suggesting you can't just move to any country and get their benefits. But many countries you can move to establish some form of kind of residency. Again, this is a do your research, because this can take many, many years to actually do. But sometimes you have the quick version of it, which is you're married to somebody who has dual citizenship. I know we interviewed Modern Family, and this was the case. And one half of them is Canadian. And so they actually moved to Canada. Now, you can't live in the US and benefit from Canada's medical system. They had to move to Canada to enjoy that benefit. But it's an amazing benefit.
Yeah. All right, Maggie, let's get into the specifics about your plan. I am dying to know all the details.
Okay. Well, we're going to go through a few details of what we're doing, and then we'll get into exactly what it's going to cost and some of the cost comparisons of like what we compared. Look, the first thing is, we've got myself and Greg and then 3 kids. 5 people to insure costs more than 2 people to insure. We have made a decision that we made, a while ago to put our kids on our ex's medical plan. So they're both of our ex-spouses, because either the kids could have been on any of ours all this time. They happen to have been all together on ours. We are going to do that. It's an amazing luxury that we can do, or privilege that's going to make the cost significantly lower. It is definitely a silver lining of being divorced. Like there's a lot of other downsides for make people feel better of like, I can't travel full time with my kids. I can't relocate, all sorts of things. So I'll take this silver lining. And look, but if we couldn't do this, we would have just budgeted more, right? And I'll give you an example. So like, when I say budgeted more, like no new treadmill, mic, stuff like that, like we would have just made some trade-offs or we would have worked longer, who knows? But I will say a huge trade-off is, we also pay child support, right? And if we weren't paying child support, that is significantly more than what the cost of insurance for our 3 kids would be in the marketplace, is my point. So when I often think of stuff like that, just from like a lot of financial things to me are very like mindset focused on just framing up, even just like we talked about at the very beginning with medical insurance, just framing up, you just have to accept you're going to pay more for medical insurance if you choose to leave your job. It's the price of the thing. So I just think that even when I think about, the fact that we're not having to pay for insurance for our kids anymore, because we do have the luxury of being able to put them, my daughter, we're putting on my husband's insurance, and then Greg's kids are going to go on his ex's insurance. And it's a really nice luxury, and I'm very appreciative of it. I think my joking point is I would rather just pay for their insurance and then not have to deal with child support. That'd be a nice trade-off also. But anyways, moving on. Second thing is we're not doing COBRA, which we already mentioned. It's just too expensive. And again, when we get into the costs in a second, I'll explain why. It's not worth the incremental cost to us. So yes, there's the nice convenience that it keeps us with our exact same insurance providers now, but just it's not enough of a benefit in the end. So ultimately, like Mike said earlier, we are going to do a plan through the Affordable Care Act, aka the marketplace, aka healthcare.gov, which is the actual website where you do it. We're going to end up doing a version of there's a lot of different plans, which we'll talk about in a minute, but we're going to do a high deductible plan so that we can keep an HSA, which we, still believe is an amazing savings vehicle that we want to continue to leverage. We did an episode. It was a really early episode, Mike, episode number 59 on the amazing tax benefits of FSAs, HSAs, and DCAs. But we want to keep the benefit of an HSA. Can I tell you a quick HSA tip that I learned?
Sure.
Have I mentioned this to you? You're not going to know till I say it.
No.
Okay. So someone, one of our listeners told me this. So I was trying to think of the quick way to say it. So I always thought of my HSA as someday I'll have some big medical expense and I'll use it for that. And I don't use I don't pull day-to-day stuff out of my HSA. When I have a medical expense, I use my HSA as a long-term investment savings tool because it's growing tax-free and it's just a great benefit. But someone told me, and this is true, I've validated it, that you can make a claim 20 years later. So they basically were like, keep great documentation, save your explanation of benefits, all your receipts, all your stuff. And so I've had, $6,000 worth of medical expenses last year, whatever the amount was. I didn't cash it in my HSA, but in 5 years when I have to, get a kid a car or start somebody in college, I can cash it out then. So I always thought of it as like I would use it for real-time expenses when and if they occurred. I never realized I could actually save up all my medical expenses and my claims essentially, and then make them whenever I feel like it, and then use the money for whatever I want.
Mm-hmm.
It's pretty cool. Did you know that?
Yes.
I had no idea.
Well, it's probably because like when we've been talking about HSAs, the real benefit is just keeping it as long as you can, even past age 65, and then using it for non-medical expenses. So if you do need the money in 30 years, you could just take a disbursement against an expense from a long time ago and get the cash back. So it's a great benefit if you do in fact need the money.
Yeah, and it's amazingly flexible. Mm-hmm. It's even more flexible than I realized. Like, because your point, there's what you can do with it when you're over 65, but then there's what you can do with it as an emergency fund, essentially for anything, as long as you just keep the medical expenses. Yeah. Anyways, we're going to do we're going to do a plan through healthcare.gov. We're going to do one that allows us to still keep an HSA. So the trick with these plans is, just so you guys are aware of kind of how this works a little bit. The healthcare.gov site is amazing. We'll put some different links into the show notes. Within 60 days of losing your coverage through your employer, so like, Greg and I losing it because we're leaving our jobs, we will qualify for their special enrollment period, because otherwise they have like an annual enrollment period, just like companies do. And you have to have a change in circumstance to qualify. One of them is leaving your job or losing your benefits in any way, which is what will qualify us. So we can't even actually finish the application right now because we have to wait until 60 days to when we're no longer on our company's benefits. So first off, when you go to the healthcare.gov site, you can create an account and you can kind of start the formal process. I wouldn't even recommend that until you're 60 days out, because it's just, there's a lot of things that are like hard to answer and hard to fill out. So when you get to the site, you can inadvertently end up in what might seem like a very complicated process where they're asking you a million questions. Or you can go to the See Plans page, which we'll put a link to in the show notes, where you can just see the pricing and plans. And you literally enter in your age and your sex, and you get to see all the plans in great detail. You can put in your specific doctors, any specific prescriptions that you need, any specific medicines like inhale or anything. And it will show you which doctors and medicines are covered on which plans really easily. It's a really nice, it's actually like a well-organized site all in all. But I will say, the application itself is a beast. It's easy to get to that pricing view, which is where I would suggest you spend your time researching early on. And it's where I've spent most of my time. But ultimately, you'll have to make, just like all your medical insurance and benefit kind of decisions, you'll have to make some decisions about what's important to you, right? So I'm going to have to switch some doctors, right? Like I discovered that, my OB, who I've been going to for a long time, doesn't take a lot of these plans and some of the plans that I would want to go on. And which is, at first I was a little more like bummed by that. And then I asked some of my friends for their doctor recommendations, and they loved them and raved about them, and they're covered. And so I was like, okay, I will switch, and I'm not having any more kids. So I'm not, quite as tied to certain doctors. And it's a trade-off I'm going to have to make. I will need to establish a new relationship with a new OB, and that's okay. I'll still have great coverage. And so again, you're just going to have to make your own personal decisions about what plan makes the most sense for you, just like you're doing when you go through annual enrollment at work and you're trying to decide, do you want to pay more upfront or do you want to pay more on the flip side and, have a high deductible? If you need help with even just those trade-offs in that decision, we have an episode that we did, episode number 62, on how to choose the right medical insurance at work, that just like walks you through how to think about insurance and the trade-offs of, Mike, you're always good at kind of saying like, in the end, you're often going to pay the same amount of money, whether you pay it through a premium or you're, some of the, like I'm on a high deductible plan. I have a really low premium, but I pay a lot when I actually go to the doctor.
Yeah.
Right. So you're making some bets on how often you're going to have to go to the doctor and what your personal medical situation is. Yeah. So we are using a marketplace plan, which we'll share some costs on in a minute. So we also plan to augment our ACA plan with travel insurance when we're traveling abroad, like this summer, we're traveling for 6 weeks. And then also if we were doing like another summer, we may do some long-term travel in the US, we'll definitely augment it with travel insurance, because a lot of these plans don't have great out of state or definitely out of country coverage. Mm-hmm. Before we get to the costs, which we're headed to, I will mention dental and vision insurance real quick. So I don't know how you feel about dental insurance, but mine has always been, what'd you say?
I have feelings.
You got feelings. It's kind of like, I'll give you an example on my current plan. It has a $1,250 max on it, $1,250 max. That's literally the name of the plan. There's like two plans we have. It's like the $1,250 max and the $2,500 max. And then usually ortho is kind of where you go for the $2,500 max. It's ridiculous. Like I had a crown this year. I had to pay, I don't know, close to $1,000, maybe more. I can't remember now. But it barely covers anything in the first place. And considering what you pay and what the max is and how quickly it runs out. And one of the things that I learned this past year, which I thought was pretty cool, is my dentist office and another dentist office that I happen to be at for TMJ stuff. So I learned that this is pretty common at dental practices. They actually offer basically like their own insurance plan. They wouldn't even call it insurance, but like at my dentist, it's called the Smile Advantage Plan. It's a membership-based dental savings plan that provides the quality care you deserve at a price you can afford. And so I would pay, and in this case, I'll give you an example. For dental, it is $450 a year, and it will include my 2 cleanings, x-rays, an additional emergency visit once a year. So if I call and have some pain, they're not going to charge me for that visit to come in. So 1 emergency care visit, an oral cancer screening. My dentist happens to offer free nitrous oxide, which is laughing gas, which is great. That continues to be there. And then an automatic 15% discount off of any treatments that I have to have throughout the year. And quite honestly, if I had that plan this year instead of dental insurance and like my crown, I would have paid about the same amount of money. Yeah. So I'm going to do a plan like this because I'm basically prepaying to get, kind of a discount on cleanings and stuff. And I still have a relationship with a dentist. I can call somebody. And that's the other thing it includes is just the fact that I can call somebody in the middle of the night when my, something crazy happens.
All right, Maggie, this has been a lot of
Build
context leading up to what I think people are really curious about. How much are you going to spend on these plans?
What's this going to cost us? Okay. Well, I think, a little bit more build up. I'm going to share what we're currently paying, what COBRA would have cost us, and then the range of things, and then kind of what it's actually going to cost us. So I know this is sometimes I'm a more visual person, so this may be tough to listen to for folks and really hear the comparison. So we'll try to provide some summaries at the end, but I'm going to give monthly and yearly amounts because I think it's helpful to think about them both ways. So what it costs us today, first off, we pulled the kids out of this cost. So we costed out Greg's, what his insurance would be if he didn't have our kids on it, which he does now, so that this is truly an apples to apples comparison. So today for Greg and I to be insured through our employers, the premiums that we pay $201 a month. And all these numbers are for both Greg and I combined, to be clear. We pay $201 a month or $24.16 a year. So $2,416 a year. The other thing that's worth noting here, Mike, is, that's a pretty low amount. I mean, Greg pays even less than I do, but he also works for a hospital system. So I feel like if anybody was going to get that cost down for their employees, it should be a hospital. We both are benefiting by the fact that we're each employed by that company. If Greg was on my insurance or I was on Greg's insurance, because it costs a lot to add a spouse to your insurance, especially if they are already employed. Most companies have a clause about that of they'll cover your spouse sometimes at a subsidized rate if they're unemployed and they don't have insurance available, and sometimes not even. Doesn't even matter if they have another option. So I mean that lower amount is because we are both individually employed by our companies, and so that's each of our companies' costs added up. Sorry, what we pay for our medical benefits. So that's the amount that comes out of our paycheck for each of us to be insured today. $24.16 a year. COBRA, drum roll, if we just me and Greg move to COBRA, it would be $1,251 per month or $15,000 per year. So in case it's not obvious, this is why I'm not moving to COBRA.
So said another way, your employers are spending a little over $1,000 to subsidize your insurance plans.
Yeah, said another way, each of us, because it's just easier to think about that individually. Each of our employers, COBRA at each of our employers is $600 a month, 600 plus a month. And so when you add it up, it's $1,251 a month across both of our companies. And it's a lot.
But I will say that if you were to just if you had no other options and you needed this for 18 months, $1,250, it's not going to ruin you. It's expensive. It's more expensive than your other options. But COBRA's a pretty good option if you're limited.
Well, what's ironic is wait till we get to another cost in the beginning, because it's oddly close to this, which is just a funny coincidence. I had to recheck my numbers. It was within $2. So I was something doesn't seem right there. Back to just the benefit that you're getting, how much our employers are subsidizing the cost of medical insurance. That increase from what we pay today, from Greg and I's premiums versus what it would cost us through COBRA, 521% increase. That's crazy. I mean, that's why people are afraid to leave their jobs and take on the cost of medical insurance, because it's a 5 times increase. It's big. But let's get into some other things. So I'm going to start with what medical insurance would cost us without a subsidy. Okay. Because, and this is important because we're planning on qualifying for the subsidy, and that's why our insurance is going to get to a much more manageable cost eventually. But in the calendar year of 2022, we're working for half the year and we're retired for half the year. So we're not going to qualify for a subsidy. So we're going to pay a premium, a larger rate for the second half of 2022. And in 2023, we're going to qualify for a subsidy. And I'm going to walk through what that's going to look like. I'm going to give you the ranges of what insurance could cost us on the marketplace, because just like with your employer, there's a range of plans you can choose from. And so the rate for us, for me and Greg, so 41-year-old female and a 43-year-old male. The low end of the cheapest plan we can get on the marketplace for both of us combined is, by the way, if anyone's like wondering what this is singly, I've also done it for like one of us. There's not a big like economies of scale of one person versus two people. It's not like we're saving a bunch of money because it's Greg and I together. Yeah. We actually may end up doing a different plan at some point and doing it separately. Like there's almost, I think I want to say there's like no savings actually. And if there is, it's like $5 or something tiny. And so you could split this in half. All these numbers you could split in half to know what it would be for a single person. The low end of what we could get, the cheapest insurance we could get on the marketplace for us would be, with no subsidy, $1,032 a month or $12,384 per year. Then the most expensive plan we could get would be $1,993 a month or $23,916 per year. So that's a big range. That's a range of like $6,000 a year per person, all the way up to $12,000 a year per person, or for us combined, $12,000 to $24,000. It's a big range, but it shows you the range of options that are available in the marketplace. A lot of choices. Now, like you would expect, those cheaper plans, you're paying a lower monthly premium, but you're going to pay more out of pocket every time you go to the doctor, right? Versus with the Mercedes of plans there. You're going to have like low copays and your deductible is a lot lower and things like that. So it's a trade-off that you've got to make personally. Now, we are not yet in our 60-day window, like I mentioned, of being able to actually like do the final pieces of signing up for a plan. And so we've got a pretty good idea of the type of plan we're going to go with and kind of the level, but we haven't picked like the exact plan, but we're likely going with a plan that's like, I'll give you the exact name of it in case you're curious, but it's called the Aetna CVS Bronze plan. And it is $1,252 per month or $15,018 per year. What's crazy is that is the exact cost of Cobra. And I don't know I know you're not looking at the numbers, you're listening, but I had to go back and be like, did I mess up something in my math? It was off by $1 every month, but like by the time you did the math for a year, it was back to the same dollar amount. So basically $15,000 a year is about where we're going to land on the type of plan we are choosing within that option. Again, remember the range was like $12,000 for the cheapest plan to $24,000 for the nicest plan. So because we're going with a high deductible plan, we're kind of on the lower end, but not the bottom end of that in terms of what we're looking at. Now, let's remember that number because that's an important number. That's the starting highest end price. One question real quick that people may have is like, well, I could keep Cobra for 18 months and it's about the same price, but Cobra doesn't give me the subsidy, remember? So yes, I could keep Cobra for 6 months and then switch to ACA. I just want to rip the Band-Aid off. It's kind of the same. If I was going to save a bunch of money with Cobra for 6 months, I'd totally do Cobra. But because it's like literally the same price for me to get an ACA plan. And we may even do like a cheaper ACA plan for 6 months in 2022. But I don't even want to mess with Cobra. I just want to go ahead and make my transition over to the marketplace and get used to it and get settled with new doctors. And I just want to kind of do all that at once. But let's talk about the subsidy, because that is where a lot of people who are afraid to take, not afraid to like take the plunge of early retirement, but worried about the cost of medical insurance. The subsidy is what should remove some of your worry and what should show you that this is actually can be a lot more affordable if you're truly planning on retiring. Because if you're truly planning on retiring, you've saved up a lot of money and you have a low income. So let's get into some details about how the subsidies work. So the subsidy depends on your household size and income. And that could change every year. The government can kind of change its tables, but roughly it's based on your household size and income. And just as an example, even though we're not insuring our kids, we still get to count them towards our household size, right? So Greg claims one of his kids, his ex claims one of them, which is pretty common in divorce. I claim my daughter. So we get to claim 2 kids. So we have a household size of 4, which dramatically changes the subsidy we qualify for. And we're still only insuring 2 of the people in that household though. So your eligibility for the subsidy is based on the income in that year that you are covered by your health plan, which is my point on 2022 of, so we're employed for half the year. So we're making too much money to qualify for the subsidy. So this means that you basically have to estimate your income every year when you're applying for the subsidy. And I had a whole conversation with a rep on the phone about how this process works because I was a little confused by it. But the idea is you're estimating your income. If you're unsure what your income is going to be, you've got to make your best guess. If you guess wrong, you'll end up having to pay back some or all of the subsidy dollars that were applied on your behalf. Or if you guessed too high for some reason, you can, I think you can somehow actually get the subsidy later sort of applied, like when you file for taxes that year. So I'm going to learn this whole process in detail at some point, because I'm not going to be able to perfectly predict my income, because some of my income is, again, just based on some things that I can't predict. But the spirit of this is, if you're truly early retiring, then your income is going to be low. You've pre-saved for retirement. You don't actually have a lot of income. You're planning on drawing down on your investments, but that's not income. The only part of that that's income is the part that's been a gain, right? So if you invested $10,000 10 years ago and it now turned into $20,000, $10,000 of that is going to be reported as income, and you're going to be taxed on it, either short-term or, in that case, long-term capital gains. But it's important to remember that, and for people that are truly thinking about early retirement, the whole concept is you've saved a lot of money in advance and you're now going to slowly spend it over your lifetime. That's a lot different than having a job where you earn proper income. And, there's a lot of people in the early retirement space who have like passive income and are, doing rental properties. I've got some, Mike's got some. That's going to count as income, right? And so you've got to think about all these different sources of income that you may have in terms of what you'll qualify with from a subsidy standpoint. But the way I think about the subsidies, and, back to kind of the mindset around this, is you're either qualifying for a subsidy because your income is low, and that's great because you should, and you don't have a lot of income coming in, so you get the subsidy. And now you're not as stressed about the high cost of medical insurance. Or you've somehow made a bunch of money and you no longer qualify for the subsidy, but now you have all that money to pay for your medical insurance, right? Does that make sense, Mike?
Mm-hmm. Yeah, it does.
Okay. So to me, it's either like you're operating in one of those two worlds of like, you got a lot of money and you don't qualify for the subsidy, and boohoo, now you got to, pay a higher cost. And I don't mean boohoo in an insensitive way. I'm just saying, like, back to the very beginning we started with, like, you just got to reframe your mindset and realize insurance is expensive. Either your company's paying for it or you're paying for it because you want complete freedom. So let me get into the subsidies, because this is where, to me, it gets really exciting, because you might still have some sticker shock of like, oh my gosh, y'all are going to have to pay $15,000 a year for insurance. So we might pay $15,000. This in 2022 for half the year, we'll pay about $1,300 a month for insurance. In 2023, we'll qualify for a subsidy. Now, let me just like walk you through. I'm not going to walk through all of these, Mike. I was just going to like give some examples.
So in our show notes, you have developed this huge table of costs. You're not going to walk through every single one of these numbers, are you?
No, I'll put this chart in the show notes. So I did my own chart. These are not the exact thresholds of the subsidy amounts of the income changes, but I did $10,000 increments of annual income between $80,000 and $190,000. I wanted to show what the subsidy would be at those rates. So I'll give you an example. At $190,000, if that's Greg and I's annual combined income, we don't get a subsidy, which, to my point earlier, like, that's fine. That's plenty of money to cover our $15,000 in medical insurance costs. Now, starting at $180,000, which is a lot of money, we start to qualify for a subsidy. So if our income is $180,000 in 2022, I'm going to use that because this is the current year we're in, then we'll qualify for a $67 a month subsidy. I'll give you some totals in a minute once we get to some higher amounts. At $170,000 income, we qualify for $138 a month in a subsidy. I'm going to keep bumping down to some lower numbers. At $100,000 annual income, we qualify for a $681 monthly subsidy. So that is more than half the cost of our medical insurance right there, if we make under $100,000 a year. So that, just in that example of if our income is below $100,000 a year, which, by the way, it will be. So just to be clear, I'm retiring. I'm not going to be making any money. So at $100,000, the subsidy would be $681 a month. That is more than half the cost of our insurance. So if our income is below $100,000 a year, we will save half the cost, and it will bring our new monthly cost of insurance to $571 a month or $6,800 a year.
That's great.
That's like super reasonable. And then let me give you an even better number that I love, which is my personal goal.
Okay.
Is at $80,000 annual income, which remember our cost of living is about $80,000 a year. At our annual income of if we can get our annual income below $80,000, our monthly subsidy for insurance will be $939, which will bring our monthly cost of insurance to $313 or $3,750 a year.
Awesome.
That's not that far off what we're paying now through our companies. Mm-hmm. So I'm pretty jazzed by I have to tell you a year ago, I didn't know much about the subsidies. I didn't realize how much of a benefit it would end up being to us. It's a pretty sweet benefit. And I've been paying a lot of taxes for a long time, so I don't feel bad using that benefit, quite honestly. I also plan on doing a lot of things to give back to this world in my early retirement. So I can sleep at night. I'm excited for the prospect of subsidies. And again, I think it's something that should give people a lot of peace of mind when they think about the cost of medical insurance, which is people's, number one stressor when going off and taking a plunge, like a plunge, even if it's not a plunge into early retirement, just a plunge into entrepreneurship. And back to a really important point, either let's say you take a plunge into entrepreneurship and things aren't going so well, your income's going to be really low. And so you're going to qualify for a subsidy and your insurance cost is going to be very, very reasonable. Or you're doing wildly well in entrepreneurship. You're making over $190,000 a year and you're not going to qualify for any subsidy, but you take $15,000 out of your $190,000 a year and you pay for your medical benefits.
Yeah.
Medical insurance. I need to quit using the word benefits. Sorry.
Well, Maggie, I am super impressed by the amount of research you put into this episode. This sounds like a great plan for you.
You like all the spreadsheets I did? I got even more detailed spreadsheets beyond what you've seen, Mike.
Wow. All right.
Be impressed.
All right, Maggie. I think we should hit our top 3 takeaways.
Okay. I think number 1 is you need medical insurance, but there are a lot of options to consider, a lot of trade-offs you can make on how you want to approach it. And ultimately, in the United States, I actually think the Affordable Care Act and the healthcare.gov marketplace is a really amazing path and benefit that, didn't exist 10 years ago.
Number 2, do your research well in advance of making a decision and then budget for those costs.
Okay. Number 3, really dig into the subsidies as it can make the cost of insurance significantly more affordable for the average family or person.
All right. Thanks, everybody, for listening. If you've been challenged or inspired by what you've heard, please rate and review the show. You can also subscribe to make sure you never miss an episode.
If you have any thoughts or questions, we would love to hear from you, and you can leave us a voicemail or text us at 404-981-3370, or you can hit us up on Instagram.
All right. Thanks, Maggie. This was fun.
Thanks, Mike. I hope this helps for all the people who have been asking us about benefits. I hope this answers all your questions, and if it doesn't, hit us up with anything specific, and we're happy to answer you directly.
All right.
Bye. Bye, Mike.